This chart measures every major bull market since the 50s. Right? All indexed at 100 at the start, and then track day by day to see how they compare. Same start line, same benchmark, same rules. And right now, the red line is at the bottom, and that's us. That's us right now. Okay, October 2022 to today, because that's basically since that's when this bull market started. So the question is not whether markets go up over time. The question is what kind of bull market are we actually in, and most importantly, how does it end? So first, let's be precise. This chart measures two things simultaneously. Length, how long a bull market lasts. And two, strength, how much total return it delivers over time. Every lines begin at 100, okay? So we're measuring all of them separately. Even move higher, every move higher is basically a cumulative gain. No dividend reinvestment tricks, no leverage, no survivor bias, none of that stuff. Well, basically, bull markets are not created equal. Some burn out hot and die young. Some grind higher for years. Some deliver massive upside and then give it all back. History does not rhyme neatly here. So let's talk about the famous one. Look at the 1982 to 1987, a monster rally of inflation-crushed valuation. You see that one? So, and then look at the 1990 to 2000, the tech bubble, explosive gains, parabolic acceleration. Look at the 2009 to 2020. It's the post-GFC bull market. The one lasted 11 years. Right? That's the one post the great financial crisis. And notice something critical. The longest bull markets are not the steepest early on. They start quietly, they look boring, they feel underwhelming until they don't. And that's my point all along, is the least you hear about it, the better off you're going to be. The more people say, oh, the market is going up, the market is going great, nothing could go wrong, you worry about that. But when they don't talk about it, when they say, oh, we're overvalued, which is kind of what we're saying right now, then you're kind of safe for the time being. The most dangerous bull markets are not the one people stop questioning. The most dangerous bull markets are the ones people stop questioning. That is something that I tell my subscribers all the time, and my Patreon members as well. Watch when they don't talk about the risk anymore. So now let's talk about this cycle, the red line. October 2022 onward. So what's striking is not how high it is. What's striking is how fast confidence returned. The bull market did not emerge from a banking system collapse, mass bankruptcies, forced deleveraging, system balance sheet repair. It emerged from the fastest hike in 40 years, the most inverted yield curve since VOCA. Persistent inflation above target, exploding federal deficit, and a Fed that paused but never actually loosened. That is historically unusual. Past bull markets were born from relief. This one was born from denial. That's the interesting part about that. So next, here's where this chart becomes uncomfortable. Notice where most bull markets started. They began at low valuation. 1974, 1982, 2009. Markets were cheap. Risk was hated. Cash was king, as you remember. But October 2022, valuation never truly reset it. PE remains elevated. Profit margin stayed historically stretched, and mega cap concentration increased. This bull market did not start from ashes. It started from hope that nothing would break. That's a different kind of foundation here. We're already high, we want to go higher. So now look carefully how smooth some of those past lines are. Broad participation, multiple sectors contributing. Now compare that to this cycle. Handful of names, driving index level returns, right? AI, mega cap, passive flows. So when bull markets are narrow, they don't collapse immediately. They thin out first. This chart doesn't show that directly. The history does. This is very different, right? You're focusing on a few stocks, on a few industries now. And of course, the most important takeaway is this: bull markets do not die of old age. They die from policy errors, liquidity shocks, or earnings reality checks. And the longer they run without fundamental repair, the more violent the adjustment becomes. Every line on this chart ends the same way, with a drawdown that investors said would not happen this time. So when you look at this chart, don't ask, how high can it go? Ask, what assumptions does this bull market require? What breaks those assumptions? And who is positioned for that moment? Because history does not repeat, but market always overestimate the permanence, and this chart is a proof.